Well, thank you. Thank you for being here. We appreciate everyone coming out. This is our June market update. We've had a lot going on so far in 2025. I wanted to start with some general housekeeping. We're going to go for 1 hour, and there's going to be no scheduled breaks. But if you have to get up and grab a coffee, refill the water, grab a snack, please feel free to do so. Or stretch, walk around. We'd also really like to welcome any questions you guys have. Don't necessarily have to hold those to the end. We want this to be interactive. So, raise your hand and interrupt Andy in his train of thought to get those answered. If you have something private and you want to speak to any of us one-on-one, we're going to stick around after. So, come grab us. And then lastly, the bathrooms are located just outside, down the hall and to your right. So that's housekeeping. I also want to say hello to our team members. I got a little picture of them here, but some of them are here, and I'd like to give them a little round of applause and a shout out. They put a lot of effort, into putting this together, but they also put a lot of effort every day into your guys' financial planning. So thank you, team. And Andy, of course, is here as well. And I'm Hunter, if anyone doesn't know me. So I do want to mention also that we have a pizza truck that is over at the office at 500 Market Street. It's firing up right now. I know I shouldn't say fire, probably. We do have ice cold water. And Andy usually finds a way to have an ice cold beer in the office. So if you want that, you got to go to Andy. But please come on down. I think we got 50 pizzas. So we need your help. And he's on a diet too. So please come on down. That's going to happen right after we get done here. And then we're also going to have a shred truck there. And that's going to be our shred and slice event. So if you have those confidential documents that you're trying to get rid of, bring them on down, dump them in that truck. Sounds good? All right. So of course, you guys probably see the cameras, and this is, we're live right now. And if anyone isn't comfortable, if we have some camera shy people, you don't want to be in the recordings, which we're going to probably throw up on our website after, and send out a blast to the folks that couldn't make it. Just hold your questions till the end, and we'll get to those after the cameras are shut off. But I wanted to give a round of applause to Bo Gogren too. He's here. So Bo's my brother-in-law. He's also an avid, I would say, semi-pro snowboarder, surfer, and golfer. So thanks for being here, Bo. So as we usually start out, we have to go over compliance. One of our compliance officers is in the room as we speak, so I promised Kelly that we would go over this. You guys have a copy in front of you in the printout kits. We take our disclosure very seriously. This business was founded on integrity, honesty, and full disclosure. So if you guys have any questions, again, come up, ask us. Anything about our licensure, our registration, our firm setup, we'd be happy to go over those with you. All right. I can skip through the fine print stuff. Yeah. I'm going to take a peek. I'm going to take a peek at the agenda. It's our usual setup that we have with our market updates. We're going to look at where we've been, where we are today, and a little bit of Econ 1 sprinkled in there. Of course, we're going to go over tariffs. Everyone's excited about tariffs. And then, Andy's going to wrap it up with some where we may be heading. And I'm going to kick things off with where we've been. And really, that is, the theme is going to be inflation. We've seen inflation trending down, which is a good thing. It was quite high post-COVID, but we expect that trend to continue. We think the Fed, and in particular, Chairman Jerome Powell has, in the back of the office, we call him J. Powell. We think he's done a great job. And he's earned our respect for the hard decisions that he made back in 2022 when he had to, and the rest of the Fed had to jack up interest rates at the fastest rate ever to combat some of the highest inflation we've seen in many years. So they did what had to be done. That being said, we don't want inflation to go backwards. We don't want it to get into the negative territories. That's called deflation, and that is a scary thing. You can ask Andy all about that afterwards. We like to think about I-95, and the cars zipping up towards Maine. You don't want those cars to start going in reverse. If anything, you want them to be going the speed limit, and that's what the Fed is going to be trying to do. Get the cars to be going the speed limit. They still have a little bit of work to get to that 2% inflation mark. But again, we think that trend is going to continue, and we do think that we're going to get to that 2% inflation mark. That being said, I wouldn't wait for the Nike shoes that cost $200 now to go back down to $100. We don't think that's going to happen. You're probably going to be waiting a long time. And the same thing with interest rates. A lot of home buyers ask us, are we ever going to get the chance to see those low interest rates again, or when am I going to refi? I don't know if those interest rates that we saw post COVID and then 07, 08. I don't think we're going to see those for quite some time. So interest rates, are probably going to stay around where they are. We're also in an age of what we like to call the Magnificent Seven. So, I know you guys have probably heard about the 7 largest stocks in the market, and you probably know them. Apple, Google, Meta/Facebook, Tesla's in there, NVIDIA. A lot of people have heard about NVIDIA recently. Raise your hand if you've heard about artificial intelligence, right? So all these companies have done quite well with AI, and they're just massive companies, and they really have an impact on the broader market. So whatever these companies are doing, likely the rest of the stock market is following. And in April, we saw a look at what that meant. Some people are calling it the tariff tantrum. We saw a rapid, very rapid decline. The decline wasn't too big, but Andy's been doing this for 40 years, and he thinks it was tough for him to remember the last time we had a drop that quickly. The last time was Black Monday, probably 1987. So I like to call what set this off a man-made event, and that was the tariffs, right? President Trump rolled out these tariffs, and it just shocked the markets. It started a global trade war, and we saw a fast decline throughout April. What's happened since then, Andy's going to get into, but he did roll back some of those tariffs, and we have seen the market slowly climb its way out of the pit, but we'll see. Tell us now where we are today.
Thank you, sir.
You want this? Oh, you want
I'll take that? Yeah. Thank you, Hunter. So I think a lot of people were celebrating our 40th anniversary last year. It might have even been on this same day last year. We had a great event out at Ordeon Point, and I made a promise to you, which was to start every one of these meetings by trying to embarrass my son publicly. And I'm going to stick with the same theme as last year. So Hunter I'm trying to get a handle on it, but I think he was about 7 years old. And he and the next door neighbor boy, took off. They escaped. And after about 20 minutes of searching everywhere, Nancy and I, young parents, we hit the panic button, called 911. And oh man, so we live in a small community. Most of it's volunteer. These guys love to get in the truck and, and come out. Dean probably knows half of them. And, all the King's horses, all the King's men, ambulances, cops, the big engines. And then, of course, as soon as they settled there, Hunter and Julian came walking out of the woods. Everything was fine. I don't know what they were doing, but the chief fire guy was really very nice. He was all decked out, like he should be. And he decided, instead of being mean or reprimanding the kids, that he'd make it an educational opportunity. Coach them on not doing making sure your parents knew where you were, and then in the end of it. He said to Hunter, is there anything else you need to tell me? And Hunter looked up and said, my dad swears. A lot. That was the beginning of our professional relationship. Thank you for that. Okay, going forward, not backwards, right? Where we are now, I'm not going to read this to you guys. I think what happens with a lot of these meetings is a ton of time is spent on data about where we are today, and I think that we can sum it up pretty quickly without reading you all of the statistics. Where we are today is just about even, which is surprising for people. Everybody's coming into the office for their periodic reviews, and you can see like a cleansing breath when they look at their accounts and tally them up and see how little they have lost so far year to date. And even sophisticated investors, I think, people that are really paying attention, are coming in and saying they're delayed. I'm not doing this or I'm not doing that, because of the markets. But that is a lousy way to run a financial plan. Based on the markets. And when you take a look at it, the S&P 500, this is just as of last Friday, the S&P 500 is at 0.5% to the good, in the green, year to date. And I will mention the international, the Dow Jones Global Index, 11.8% year to date. Which makes perfect sense. Things like, Tony, we talked about military in Europe. If you're living in Poland right now and you're worried about NATO and you're worried about Russia and you're worried about Trump, the Raytheon of Poland is probably getting the factory going, cranking. And the European Union countries in the UK have just taken off. And we get a lot of pushback sometimes about the international portion of the portfolio, but not so far this year, right? And really, it's important to have that mix. It's one of the basic platforms of diversification. What I also want to point out, though, is after all this angst, which is the real word for it, go back when we have a drop in the stock market and look how far. It's a great exercise. Look how far back in the calendar you have to go, to see where you were at that high. And I think really even towards the bottom of the second week in April, we were talking about Good Friday a few minutes ago, when things tanked, we were only back to like the summer before. And year over year right now, well, not right now, as of the close of business last Friday, S&P's up 13%. In the bond market, which became the crisis du jour during the first 2 weeks of April around Easter time, coming into Easter time, has held its own too. I mean, the difference between the 10-year Treasury and where it was then after all that talk, and we'll talk about this and where it is now. I'm not saying that it's incidental. I'm not saying that it's not a key performance metric. We pay more attention to the bond market than we do the stock market. But it's really held its own. So that's where we are right now. Where we also are right now is households are looking pretty good. You've got these charts. If it's too much fine print for you, we could always send you the deck if you'd like Hunter mentioned, the disclosure, all that stuff. These are from our colleagues out in Omaha, Carson Financial. When you take a look at the household balance sheets, there's a metric that people track called the wealth effect. And what it really is people subliminally maybe. I mean, some of us keep meticulous track of your net worth. Most of you guys don't. That's why you have us to keep track of your net worth, so we can show it to you from now and then, now and then when we need to. But when the 401k, to use that term metaphorically, is high, when real estate valuations are flying and you're sitting on a ton of home equity, you feel different psychologically than you do when everything's in the tank, like about Good Friday, last spring. And economists actually study this. So real estate, for example, if you were going to buy a house, you're going to buy a camp, or even a car or a truck or an appliance, when you walk into the store or the open house, it's different when your accounts are up here than it is down here. And that's where we are right now. Household balance sheets are phenomenal, and the wealth effect is in play. Interestingly, and Hunter talked about those first 2 weeks, I absolutely don't think I've ever been in this industry when people were more scared than they were in the first 2 weeks of April. Palpable, like really afraid. Physically afraid. Part of that, I suppose, is because not everybody's, with COVID, everybody was, we were all in the same boat, right? And the partisanship and all that. But consumers still spent money, right? So even though they were afraid and consumer sentiment was down, when you took a look at consumer spending, it was miraculously high and continuing to grow. Last fall, we were just talking about, I had to give a talk for the foundation that I was just serving on. I'm coming off the board. My last board meeting's in a couple of weeks. I'm very sad about that. But I was in the green room with a guy who's a VP of research for JP Morgan. And I, did what any good financial advisor would do. I got him in the corner and grilled him. And I said, what about consumer sentiment? I mean, consumer spending makes the world go around. There's a disconnect with consumer sentiment. And I can't imitate him. He's a Scotsman. He has this wonderful accent. And he said, I can't get it exact. I have a tremendous confidence in the American consumer to buy something that they don't want, that they don't need, so that they can impress somebody that they don't even like. And that's where we are right now with consumer consumer sentiment.
The consumer spending is an artifact of tariffs and people going out and rushing to buy things before prices go up. Like cars and appliances went through the roof for sales, specifically because people bought them before the tariff effect took place. So how much of this is actually artificial and not real? Yeah,
nobody knows is the answer, right? So we call that front running. Right, so front running the tariffs, and I don't think it's going to answer your question, Tony, but I do have some data on that when we're taking a look at copper. So we're trying to figure out, how copper is doing. It's a great economic indicator, and you can see the front running going on there. And we'll get into that in just a second. But the real answer is nobody knows. It'll settle out. I think that one thing that's interesting is that the numbers are skewed. Right, so the first quarter numbers were kind of funky. We had negative GDP. That means a recession. That dirty word. It's not the boogeyman. It's just a recession. Could be coming. You have to have technically 2 back-to-back quarters of GDP for them to call it a recession. But now the numbers are really going the other way, and I think those are an indication of what's going on with tariffs and front running. So it doesn't look, we'll get into that when we get the crystal ball out, but it doesn't look like it's going to be a recession. At Essential Planning, you guys could repeat some of these things because we're like a broken record. We really believe in fundamentals, right? So what we believe in is that the stock market is priced based on earnings. So to give you an example of that, if you work for Raytheon makes profits, and their stock is worth a multiple, whatever that industry gets, a multiple of those profits. Essential Planning is worth a multiple. We just don't happen to be publicly traded. And Hunter debates the value of Essential Planning constantly when we're having our little negotiations. Or the pizza truck he mentioned down the street, same deal. It's worth a multiple of its profits. So day to day, And we're going to spend a lot of time on this today, investor sentiment and investor behavior. Day to day, that value is not trustworthy. It's flopping around all over the place based on today's news. Over time, and I don't want to say long haul like a stockbroker, but over time, company will come to fair value. And what we see here in the big drop down right in the middle of the chart, this is exactly what I was talking about. It's the price of the stocks, and this is the S&P 500 compared to the earnings of the companies, and what that spread is. And that runs at an average at about 18, maybe 17 and a half, 18 is the multiple. So you can see we were cranking along pretty good, just breaking up over the average when COVID-19 struck, and down we went. And of course, that's historic. I mean, you don't usually see spikes like that. And you really don't see spikes like the recovery, which is incredible. And we had that slide rotating through animal spirits. That's the economy. That's, animal instincts, people trying to figure out a way to survive. I mean, not literally, but the Chinese place in our community is a really good example. They stopped, opening the dining room, right? They really couldn't, and they cranked the takeout. And now today, 5 years later, they still don't have the dining room open. They're making so much flipping money on the takeout. They're like, we don't want to bother with the guests and the booze and all that stuff. So relentless innovation is how capitalism and small businesses work. People figured out a way around it, and boom, off to the races we went. I wish this chart was a little tighter, focused in. Because what you have here, and you might see it in your worksheets, is we tanked in April, right, on the tariff scare, and then fought our way back. Tariffs are like a tax. Hunter's going to talk about those in just a minute. It has an impact on, guess what? Earnings, right? So it's going to show up in the stock market. And we totally understand why why the market went down and the panic. What we don't understand is why it has come back up. Because the tariffs haven't gone away, have they? Right? I mean, I think we have one deal or something on the tariffs. Day to day.
They're on one day off the next day.
Yeah. In those first 2 weeks in April, never seen anything like it. The president says one thing, market goes down. President says the other thing because he changed his mind. Right, left, you have to admit, he changes his mind, right? And the market goes the other way. It's it's wild. Pretty orderly though, which is why we weren't in a panic. Trades were happening smoothly, liquidity wasn't an issue. In 07 and 08, back when Hunter was a wee boy, I put a trade in for a treasury and nobody wanted to buy it. That's scary, right? And when the market freezes up like that, and by the way, the Treasury market, it was very interesting on the night before the election, the Monday afternoon before the election last November, started to tighten up a little bit. That's what we're watching. This was a very orderly, collapse and uptick. And, we'll talk about this a little bit when we get into where we're going, but the market works in the future. It's in future land, right? And the market thinks this tariff thing isn't much of an issue, right? It's thinking beyond that. And we'll learn more about those tariffs from Hunter in just a second. Another metric that we take a look at that involves PE and fundamentals is called the Shiller Index. Robert Shiller's brilliant economist out of Yale. We've been studying with him since I can remember. He also does a really cool real estate index for the major cities in the United States. It's a great benchmark to take a peek at. But what he believes in is that it should be kind of a 10-year rolling average instead of just a snapshot look like I just showed you. And when you go back 10 years and bring it forwards, now we're getting pricey, right? I don't know if you can see it, and it's in red, a little bit dark, but the average is 17, like I was saying a little while ago, 17.03. As of June 30th last summer, we were up to 28.07. So we were, pretty frothy, right? Things are, the market is pretty expensive. So that's a great indicator. And the way these things tend to work is they will correct themselves. It will come down to the average. And that happens one of two ways, or maybe three. The market tanks, comes down to its average, right? A little while ago, it was double. It was at 34 earlier in the first quarter. Market tanks comes down, or earnings go up. I mean, we talked about, you mentioned AI, productivity, earnings go up. People are making more money and it catches up to itself. Generally what it is like the SAT question, some combination of the above, right? Your market bops along, earnings come up and it all sorts itself out. So what we think right now, and I hope you really hold on to this, is that we are priced pretty much for perfection, in that we were priced for perfection. Hello? Anybody on the phones back there? So what price per perfection means is it's high, and everything has to go really pretty well for it to stay there. Thanks. So the idea there is got to get somebody under 60 to help me out with this. Yeah. Okay. So the idea there is when you're priced for perfection, it's not going to take much to rock it and knock it and create another whoop-de-doo. Right? And that's what we want everybody to walk out of here remembering. We're priced for perfection. We don't know what it is that'll set it off. Could be Russia, could be Putin, could be gold. We have no idea. By definition, nobody knows what it is. But when you're priced this high, you're going to have the volatility. And that's where we are right now. One of the things we love about our clients, about you guys, is your craving to learn. It doesn't have to be about finances or financial planning. It could be wine or gardening or, golf. But you guys love to learn. And we're, I think, frustrated teachers. So we always like to get this Econ 101 piece in. And let's hit that right now.
I'm going to try to fix that before it pops up again. I think it might. I think that'll do it.
Well, we lost
it. Before Econ 101. All right, welcome to Econ 101. We're going to talk about tariffs. Most of you are probably sick of this, but we wanted to take the opportunity to have a discussion because why not? It's been the theme of 2025. And I want to put up a picture of who invented the tariff. just kidding. It actually wasn't Donald Trump. But essentially, what a tariff is a tax on imports. So when one country is bringing in goods from another country, they can put an extra price gouge on that. And typically, that gets passed down to the consumer. Now, countries will typically do this to protect their domestic industries, jobs, things like that. We've heard that a lot, that we're trying to make stuff in the US of A. Some countries do it because it's an income generator. You do make money off these tariffs. And then other countries might use tariffs to retaliate. We saw that quite a bit so far this year. Some of the downsides of tariffs is that, like I mentioned, prices usually do increase, on the consumer end, and they can, really piss off your neighbors, your fellow countries from all over the world. And I want to go over, the history of tariffs because Trump, actually didn't invent it. They've been around since our founding fathers, actually, way back when. And it was the primary source of income for the United States for most of the 1800s. Average tariff rates were around 40% throughout the 1800s, quite high. From 1890, I have up here on this chart, average inflation from 1890s to today. You can see they're quite high in the 1890s with the McKinley Tariff of 1890 tax. Again, that was there before income taxes even existed. So this was really the primary source for the U.S. to make money. That sort of settled down. We entered the Great Depression, and in 1930, the Smoot-Hawley Act raised U.S. tariffs, and then a global trade war sparked. And unfortunately, that threw us into a deeper dive in the Great Depression, really delayed things. And it wasn't until World War II that we got over that. After World War II, tariffs were pretty low. And the main reason was because we were trying to increase global trade efforts, countries healing wounds and trying to trade goods back and forth. So they were quite low for a very long time until 2018 and then 2025. So the Trump trade war, if you will, is on, and tariffs are once again in the fold. So what this means, there's all kinds of pros and cons to it. One thing that we noticed was international arrivals was actually an economic indicator that stood out to us. So we saw less people in 2025 so far, and 2024, leading up to it, coming into the country. Another way to we think about this is business deals aren't getting done. And going back to the idea of making your neighbors angry, we've heard, and you guys heard this too on the news that the Canadians didn't want to come down here because we were upsetting them. So we saw international arrivals go down. We also saw loan demands falter. So that got quite low in March. People didn't want to borrow money. With policy uncertainty, it frightens folks. They don't want to go buy a home that they don't know if they're going to be able to handle if we head into a deep recession. We also saw initial public offerings from publicly traded companies that are trying to roll out. We saw that slow down. Again, we had a lot of volatility in the market. So with that volatility, it was too risky to go public. So that came to a slowdown. And then we saw a slowdown as well in mergers and acquisitions. Companies typically buy other companies up to grow. And with tariffs, that slowed down again because who knows what's going to happen. So mergers and acquisitions were quite slow in March 2025. So, do tariffs work? Again, staying down the middle, not getting political. There's pros and cons to them. Yes, they are an income generator, and yes, they can shift supply chains. But typically, you see inflation. Typically, you see trade wars happen, and the end consumer usually gets hit pretty hard there. And lastly, the tariff talk fatigue. We've probably said the word tariff 1,000 times so far in 2025, and unfortunately for you guys and for us, we think this is gonna stay, stick around. The word tariff isn't going anywhere, at least in the next 4 years, and we're gonna be prepared to keep continuing to do our research on tariffs, and I'm gonna keep getting my tariff word count up. Tariff, tariff, tariff. All right, Andy, tell us about what's gonna be happening maybe in the future.
Okay, yeah. So now the tough part, where we might be going, but just a word on the tariffs. What's happening, what those indicators say is what we call circling the airport. Right, and we were talking about a closely held corporation, in the kind of a regional player earlier, in a pipeline into the the financial officers. And I asked them the other day that word pipeline. What's going on with the projects? Are people building bridges? Are they building airports? And what the answer is, some of them are pausing. That word really scares me, because that means they're circling the airport, right? And these are, $1 billion bridges or whatever they are. But the same rules hold true to the individual family. And I can't tell you how many times we've heard since April 2nd on Resurrection Day, or whatever that day was called. I can't tell you how many times we've heard that, we were going to, but, we're pausing. So we're not going to buy that truck. We're not going to buy that dishwasher. Take that across America. That's why you have the slowdown. So it's definitely big businesses and bank loans, everything, all those economic indicators, looked at a slowdown. That gets to be scary stuff because then you put the word recession in, and recession can be a self-fulfilling prophecy, right? Because if all of us stop buying stuff because we're waiting for it to get settled, then we will create the recession. But the American consumer seems to, either they're front running or not, they seem to have worked their way out of that. So Hunter's in the beginning of his career. Not really beginning. You've had how many years now? 7, 8 years. I'm not. So I can tell you politically, tariffs don't work, right? At all. And it's hard to find any economic data or any economist that isn't on one particular channel that says that they do. It's a tax, right? And the constitutionality of the tax is probably going to go to the Supreme Court. You guys are all going to be reading about tariffs again and again. Our point is the market is thinking past it, which is really good because the market knows all, and it's swallowing it. And American consumers are still cranking. So I'm going to take a little informal poll, wake everybody up a little bit before we get the crystal ball out and finish this on tariffs. How many of us in the room, not necessarily in the room, but how many of you use a cell phone? Okay, how many of you use Verizon? How many of you use AT&T? If the cost of your cell bill goes up 10% this spring, do you think that you're still going to use it? Yeah, get it down. But I think AT&T and Verizon get through that, right? That's the point. Because of the what?
Verizon's losing a lot of customers right now because of their pricing.
Yeah.
There's actually been a huge decrease in users for Verizon.
I don't know how that all works, but I'm dying. Someday on a rainy Saturday, I'm going to figure that out because there's free everything if I switch over. I've got everybody and my brother on my cell phone bill. I'm going to call you, Tony. But you get the point. Are you still going to have a pint on Friday night? Are you still, so it isn't going to be the end of the world. It isn't going to seize it up. Sometimes when you're predicting the future, it's easier to predict what's not going to happen. And what's not going to happen is my retirement, which I have to say at every meeting now because I'm older, grayer, and fatter. This is Hunter signing the deal at the bank for his first chunk of essential planning. Couple of happy guys. I'm convinced that he and the group in the back and the group at the office are trying to pull a coup, but I'm watching them. And my plan is to stick around, seriously. It's too much fun, not to. Hey, thank you. But yeah, thank you. You are? Love you, man.
He requested that we put a leather couch in the office for his afternoon nap.
Yeah.
Nothing wrong with that.
Yeah. There comes a time in the day when you call to get advice that you probably should wait until the end. So that that's not happening. We are having a ton of fun with it, and we talked about this yesterday, Mary. We have a code with the clients. As clients, we have to. I mean, it's our professional responsibility. When people age up, we have to be, looking out for that. So often, what we'll say, and some of you have heard us say this, is, "Hey, one of these days you should get the kids in here," and or who is your trustee? Maybe they should, come to one of the meetings. When we say, "Could they please come to the next meeting?" we're thinking you guys are going around the bend, right? So that's going to be my indicator. We'll keep track of that integrator and say, how many times a week do they say, where's Hunter? Is Hunter coming into the meeting? And then I'll know I've gone around the bend. So we talked, Tony, about copper. Anytime we talk about the future, we love to start the discussion with copper. In economic forecasting, copper is often referred to as Dr. Copper because it's such a great lead indicator of what's going on in the world. And you know why? Because people make stuff with copper. You know, it's not like gold or some of these other precious metals. People make stuff with copper. And it's pretty cool as an indicator. And you can see exactly what happened here. In the first quarter, Dr. Copper is thinking that a few months down the road, a year or so lagging, things are going to be really looking pretty good. Dr. Copper did not like the tariffs. But even Dr. Copper worked through it. You know, one of the reasons we think that that is not in our rearview mirror, it is by no means over, but it isn't the end of the United States of America. And I hope you'll join us in, in that thinking and find some peace there. We came into the year with, just like every year, with strengths and weaknesses. One of the strengths we talked about was income and growth and household balance sheets. We've only talked a little bit about AI. The work that these guys did to get this meeting through compliance, with the help of AI and our incredible compliance people out in Ohio. I think it would have taken 25 people, a few years ago. I mean, it's scary. I just watched a movie, like a twisted movie about it last weekend. And, AI was doing everything that everybody's worried about, sort of taking over the world and all this false news and causing all kinds of calamity. The scariest thing about that was the people in the movie that were running the show and their values or their lack of values. And I'm not so sure that that's the case. But doesn't matter. Horses out of the barn. The train left the station. It's here to stay. It's later on when they write the history book, it's going to be fire, the wheel, AI, right? I mean, it's going to be massive and a huge increase in productivity. Guess what? That shows up in earnings, and where does that show up? So I think you're starting to get the feel for where we think things are going. The weaknesses that we face are interest rates are a little high, not ridiculously high, and we have an outright crisis in the housing industry. The difference between wages and housing is atrocious. And that's because of COVID and really still lingering from the banking crisis in the early 2000s. So we printed up the money. We can argue whether we should have, we had to, right? But how much we printed, will be an argument for the next 100 years, whether we went over the top. But we printed up the money, and money doesn't just disappear. It's like electricity. It has to go somewhere. So if you go to the farmer's market and buy a tomato, now you don't have the money, but the money didn't go away. The guy that sold you the tomato has the money, and then he goes to the next tent and buys a nice cup of coffee, and they have the money. And famously, when you print money like we had to, it shows up in hard assets like real estate and housing. So if you own a house and you don't have any debt, it's not a bad thing. Your house just tripled in value. But if you're a kid graduating from Portsmouth High School and you marry your high school sweetheart and you're framing houses for a living, where are you going to live? Rustic County? Nowhere near around here. I mean, you wouldn't believe, you plant a Compass in Portsmouth and go out an hour, you wouldn't believe what $500,000 can't buy, right? And so we've got wages down here, housing up here. Housing makes the world go round, right? And when we see a pinch in housing, that's an issue. And I'm sorry to report for the younger people, but tell them it's going to take a generation it's going to take decade, to sort that out, because wages have to come back up, related to housing and interest rates 100%.
One of the questions that we typically ask clients, or used to, is, what did you buy your home for? And I just can't ask that question anymore because it just, it shocks me. But it's good for you.
Yeah, it's good for investor sentiment. It's good for that wealth effect, but not good for much else, really. So opportunities are, Hunter mentioned the Fed and Jay Powell. We really think that they're going to cut interest rates. What we really think is he already would have cut interest rates if the president hadn't been knocking on his door so hard. It's not supposed to be political. Not so sure that that's the case. The economics of it, we believe, inflation, you were saying it's down around 2%. I think, I don't know this statistic even, but I read that his favorite benchmark for inflation was 2.1 last week. Call it even with 2%. They're gonna, lower interest rates a little bit, and that's definitely gonna, gonna help things out. So you've got easy, and the tax package, love it, hate it. I guess Elon loved it, now he hates it. It doesn't matter, it's gonna go through. It can't not go through. It's gonna go through. We're gonna get, some pretty significant tax cuts. We'll talk about that in a few minutes. And then my favorite is looser regulations. I mentioned compliance and 25 people. I'd like to say thank you, Julie Pemberton, for helping us and sticking with us to get this meeting through. But compliance is outrageous. I mean, if you're an electrician, Rick, right? I mean, fooling around with people's houses, anything. The pizza guy, I wonder what kind of permits he had to pull. The regulation of small businesses dampens those animal instincts and that, relentless curiosity and innovation. We release that. I know it's controversial. The best, worst example of that is the oil patch. I'm an outdoorsman, I'm an environmentalist, but oil makes the world go round. Oil is the lifeblood of the economy. If the guy out, in Wisconsin fills up his F-150 and puts some extra money in his pocket, he goes and he buys a cup of coffee, or he goes and he buys that, they'll get it, I guess, or they'll just call back. How many rings does it take for us? That's a key performance indicator and part of everybody's bonuses. So oil is the lifeblood. If they drill it, they keep the costs down low. We take off from an economic standpoint. Thank you. The threats are the tariffs. We've talked about that enough. The other one is a strong dollar. I dispute that. I don't think that the strong dollar is a threat. And I am not worried about the dollar not being the currency of the global economy. I think that that's one of the things that the market's latched onto. And we'll talk about how that happens in the psyche of it. I'm going to back that up by giving you a data point. If you think of all the transactions that are going on in the world today, some of them are huge, right? $1 billion acquisition from General Electric to buy a motor plant, I don't know. Some of them are teeny, a kid buying a Diet Coke in sub-Saharan Africa with his hard-earned money. If you add them all up, it's trillions of dollars. 88% of those will be transacted in United States currency. That's just massive. And that's like turning a battleship around in the river. You cannot do that overnight. And I do not doubt that China wants to change that, or Russia. I really doubt their capabilities to do it, and to do it anytime soon, right? So I don't think we did our dollar, our currency, any favors the way that we negotiated these tariffs. I think I wouldn't use that language, but I think it upset people. But I pissed a lot of people off, and I think it's not, but I don't think it's going away. Right? And that's important information for you guys to have, because the media, every time it moves now, it's become a point of pain that gets people to tune in and keep tuning in and paying attention. Any questions on the dollar? If you live in Italy, strong dollar is not that bad a thing. No questions on that one. Yeah, our prediction, and this isn't a prediction, but what's coming in 2025 is either a soft landing or a recession. Soft landing is defined as, things slow down a little bit. Powell nails it like a gymnast in the Olympics finishing, and we don't go into a recession. We just almost do, but we don't. A recession is 2 negative quarters, like we talked about before, of GDP. Not going to happen this quarter, we don't think, but it doesn't mean it isn't going to happen. Right? Our point in mentioning this is it doesn't matter. What soft landing and recession are economic terms. It's both the same thing, a slowdown. And we're going to slow down. We had to slow down because inflation was out of control. And that's okay, right? It's just a normal economic cycle. In economics, they call the soft landing the economic phenomenon that everybody talks about but has never seen. right? This may be one that he pulls the rabbit out of a hat. That's, more luck than anything else, but it isn't going to be a depression. It isn't going to be a recession like the 1970s. It's going to be a slowdown.
Some of the economists now are throwing out a third option, and that's what we saw in the 70s, a stagflation. So there's a number of economists now that are raising the specter of not a recession, stagflation.
Yeah, stagflation's scary stuff. And my answer to that is I have tremendous confidence in the American consumer to buy something that they don't need, they don't want, and that they do to impress somebody that they don't even like. I got to work on the accent, but yeah, but I wonder if we don't spend our way out of, it just takes a lot to scare the red hot blooded American consumer. It really does. So.
Have you looked at that spending data by age? Because if you look at a lot of the research and a lot of the polls and stuff like that, the people in this room have got the money.
Yeah.
People your son's age can't spend their way out of it because they're paying, $1,000 a month for student loans, $4,000 a month for rent.
Yeah.
And so if you look at that from the perspective of age groups, at what point are we, the people that are boomers, going to stop spending?
I
can't go on forever.
I don't know if we have metrics. I read a lot about that, though. And what I believe, what strikes me as kind of interesting is that they don't want to spend like we did. We have a generation of people coming through that don't even want to buy a house. And then they don't, appliance it. And then they don't have kids. Yeah. So short diapers, long veterinary, seriously. So then they don't buy the Suburban to ride the kids around in. And they don't, and it goes on and on. But I think that we don't have metrics for that. I think it's scary stuff. And that housing data and the wages, it's tough out there.
Yeah, but Andy, also you have the guys who are spending money that they don't have by putting it on a credit card.
Yeah, we sure do. Debt, consumer debt. I mean, to me, the credit card companies are the, crack dealers in the schoolyard. They really are. Every time I get a chance, I don't want to name any brands or anything like that, but a lot of clients have deposits with credit card companies and their online banking solutions. I try to take that away every time, because what they're doing is lending that money, and I won't name the brands, but the household debt and the federal debt is crazy. It's what keeps me up at night, no question about it. Another thing that keeps me up at night, and you can't get into this conversation without talking about the 800-pound gorilla in the room, right? And I want to be polite. I think he's only about 350. But seriously, I'm threading the needle here. I don't know what the statistics are in the room. Everybody that voted for him or against it, we have a food fight with the pizza truck over there. A lot of his economic policies, I love. The way he goes about it, not so much. But what you see is chaotic. That's how he does business. I've never read The Art of the Deal. I don't think I will. But I think this has been very important for me and for my relationship at home with Nancy. Bo, don't tell your mother-in-law. Hunter, don't tell your mother. Because I've learned that her negotiation technique is chaos, right? And Nancy happens to be from Queens too, so I think it's a Queens thing. But we were talking about. Not really. So we were talking about pavers in the driveway the other day, and she just went off. I don't even, I don't even know what she said hardly. And then, I was, sort of kicking the sand, muttering, and, I went out to the garden, and, I walked by her in the garden. She's singing. She was singing out loud, and I was, 4 hours later still stewing about it. So 37 years it took me to figure this out. So I thank Donald Trump. For the financial markets, it's wild. I mean, normally these are, just a chart, pull back from it. What normally happens is stocks go like this, they go up. The closer you look, the more the volatility is. We have a chart for you on that, that goes back 100 years or something. But they move in the right direction. When you look at some of these data, when we look at like reports for clients, stuff like that, when you guys look at some of the software, it looks like a kid took spaghetti and threw it at the, at the screen. It is all over the place. So that is a big part of the future, just pure volatility. And we're going to go through a little exercise. I hope you guys will really think about this and own it on how that market panic happened back in April, and how every one of them happens all the time. So some of you just don't pay attention. We love you guys because you wouldn't need us. But some of you pay a lot of attention, and everybody pays some attention, and you can't stick your head in the sand. So think about this, and think about how you react to things, and we can learn from that in going forward, because that volatility is serious. The tariff thing is not over. The volatility is not over. I would argue that it's just beginning, right? So here's how it goes. A new story becomes the focus of investor and market attention. Something happens. The dollar I talked about. Oh, the dollar's tweaking out, and we're no longer going to be the currency of the, of the world. Just like that. So something happens that gets people's attention. Maybe they're a little nervous inside. I'm not a psychologist. Maybe you got a little anxiety that you're carrying around anyway, and you read this story, and then the media jumps on it. The media hugely overweights its importance. Why? What does the media do? Sells news, right? Sells advertising. How do they do it? Fear and greed. So a guy rescues a kid in the Mystic River and saves his life is on the back page of the Boston Globe, and on the front page is a five murder horror show in Dorchester. That's just how it works. You guys are aware of that. It's really hard in the modern world not to get hooked in. I finally got hooked in by Google. I had them, on my phone as my search engine for, I don't know, since I got a cell phone. I used them all the time. And it took me till just this year, took them to get me. And now, if I open Google, it's 20 minutes later, I'm coming up and wondering what it was that I went in there for the first time. And how they got me was alpine ski racing. Michaela Schifrin, the darling ski racer. Anything to do with blizzards, snow, skiing, I'm scrolling through. It hits like 20 of them. I had to take it off the phone. I literally did. I use a different search engine now. That's what's happening with these panic stories. They're good at it. Then what investors do is they develop, I added this, a shallow expertise by conducting research. So they go home at night and say, man, I got to learn everything about the dollar. Where do they go? Google. What does Google do for a living? Sells advertising. They just want you to click, and down the bunny hole the whole country goes. And then the client, not our clients, but then the investor inaccurately predicts how the financial markets will be impacted. I'm rolling with the dollar. It's the end of the dollar, right? We are no longer the global currency. Now it's going to be the Russian ruble. Really? Right? And when you take a look at what's going on in China and the most affluent and how they're moving, all of the BRIC countries, you take a look at the billionaires, they're out of there, and where they want most to be is in the United States of America so they can protect their dollars. We were talking about Dubai. We have a guy that we study with in Dubai. What he does for a living is he teaches people in the Middle East and in North Africa how to get their money out of their country and into the United States. And he uses insurance products to do that. And his clients do not care if the rate of return on that money is zero at all. They don't care. They just want our paper. I don't think that's going to happen. That's going to change anytime soon. So here we are, back to the cycle of an investor's panic. They become at risk after all those Google clicks of making a poor decision, right? Financial planning, I think, is all about helping you, knowing everything about you, where you've been, who you are, to help you to make good decisions. And the most painful decision sometimes is don't do anything, right? So they become at risk of making a bad decision. Anxiety causes them to do it or not. And then this is my favorite one. I don't know if you could, investors entirely forget this entire process or issue 4 or 5 months later. So I have a client in my hometown, and we were talking, he's in a panic, probably talked to him 4 times. I would say 999 of the time, the times I used the tariff word, it was this one guy. I said, well, bear markets happen all the time. It's just part of it. I feel like getting tattoos for everybody, like in reverse, so you could read it in the mirror. But you've heard me say this 100 times. Markets go up, markets go down. Corrections, known as a 10% drawdown, happen about every 6 months on average, a couple of times a year on average. Downturns, bear markets, happen about every 5. It's actually 4.5 years or so on average. Most of us have lived through 3 bear markets that were 50% or more. And if you can't handle that, then you have no business being in the financial markets at all, because nobody is going to stop that from happening. So John said, yeah, but we haven't had a bear market for a long time. I'm like, are you kidding me, John? 2018, 2020, 2022, 2024, right? This baby bear. We just had, 20 years worth of bear markets in the last 7, and he had entirely forgotten about them. So think about how you relate to news, and think about how, and the messages don't call, the messages do call, but, analyze how you're dealing with these things, and, what reality is. I guess in the end, what we think is that the markets, capitalism, are bigger than the man, right? And we think we evidenced that a little bit when he was slapped down by the bond market on this tariff thing. The reason the tariffs were repealed is the bond market said, right? So that's the profile of an investor cycle. And our strategy isn't as simple as people think it is. It isn't to do nothing. But our strategy is to use, believe me, people are very creative about the plans that they can come up with to avoid the anxiety of a stock market decline. I know you saw this on there. That anxiety doesn't go away. So when the next issue comes up, whatever it might be, unemployment, boom, they pin it on that, and around we go. So our plan is really what we believe is the only plan that has ever worked, and it's super easy to describe. Put enough money in the market so that you don't run out. No more, no less. Take a bunch of money and set it off to the side to live on, so that when we go through this stuff, you have plenty of money to live on, and then just go for a walk. Go for a walk in the woods. Yeah. So the other day, speaking of walking in the woods, I called somebody. I was in her community, and I said, let's get together for a cup of coffee, go through your stuff. And she said, I know that you're just going to tell me to stick with it, and I would rather go for a bike ride. I took offense to that, but we started thinking, and we actually have developed a, sort of a bear market action kit for you guys. And here's what it looks like. The first thing that we do is we look for losses. So I guess I just want to say that we're not doing nothing. We're not saying don't do anything. Matter of fact, we're kind of busy, and we're doing a lot on your behalf while things are spiraling down. The first thing is we're looking for losses. We want to exploit losses and offset those against your capital gains, right? We're proud of that. It's been proven empirically that adds 1%, more than 1% to your total return over your retired lifetimes, man. That's big money. And we don't like doing it, because we have to throw the loss in your face. Look, you lost a bunch of money. Isn't that great? But we do it anyway. And then the other thing is what you guys never like to hear. We call it something, fluffy. We rebalance, which means we buy, right? So when it's, the knife is dropping off the counter, we're waiting for it to settle, and then we're buying. And that's the protocol, right? Buy low. And then next up, and this is something we've talked to a lot of you about, and we usually do Roth IRA conversion work at the end of the year, because we know more about how your year went. But if the market's in the tank, we start accelerating that. So we, cranked out a list in April of everybody who's a candidate for should be converting to Roth IRA. We can convert that money at lower prices and blossom it up in the other account tax-free. And then the market came back so quickly, not a lot of it happened. So we'll visit it again at the end of the year. And then the last thing, the most important one, is triple check with the client. What's going on? What are you buying? How the kids doing? You guys, you could recite our periodic review, right? Cash flow, cash on hand, major outlays is the most important part of it. And it isn't that we don't trust you, but it is funny. But we don't trust you. All right. So. Just this morning, it was so funny. Very conservative, very tight with their money, very smart with their money. And at the end, they talked about a garage. And then I was signing off. And at the very end, he snuck in some bathroom project. I think that they didn't want to admit it to themselves. Put enough money aside to live on and let the rest of it do its thing. That's the big deal. Had a client named Howard, lost him, great guy. But he used to, the way he would frame it when he called is, I just want to know what's in your guys' minds. I just want to know what my advisors are thinking, which is what we're doing here today, right? And the other question that he used to ask is, what's keeping you up at night? What's keeping me up at night, we talked about it a few minutes ago, is the deficit. So the average American at age 30 owes $209,000. This is a year ago, $1 trillion ago. That they really didn't know that they knew. So if you were expecting a child, you can expect that they're starting with a negative balance sheet of a couple of $100,000. That's the end of an empire if we don't get a hold of it. And we can't seem to get a hold of it. I guess this is the country trying to discuss this right now in its ugly way. But if this bill comes out and they rack yet more onto the deficit, we just missed another big fat opportunity. So how will that end? Badly, right? I just don't think it's going to end anytime soon. But none of us want to leave that mess for our children and our grandchildren or our neighbors. So the deficit, both for kids and for the country, yes, sir.
When the national debt finally hits our shores, a sense where it's really upsetting markets, is that going to be more of a hit to the bond market versus the equity market, or both?
I think both, yeah. So thanks, John. I mentioned this, we watch the bond market more, than we do the stock market, because the stock market's just flopping around and comes to fair value. When interest rates take off like they did a couple of weeks ago, and basically said no to tariffs, right? I mean, really, that's not good. And what happens is if our rates go up, we were just downgraded. You all saw. It's no surprise. I mean, everybody around the world is watching us not be able to be like ladies and gentlemen and do business professionally and, sign a law and deal with it. So the rates go up. And, when you calculate out how long that has to go on before it topples over, it's not really in our lifetimes. I mean, it takes a long time. And most of that is because you mentioned the offshore. 56, 60%, I don't know the statistic to the penny, is debt that we hold, like bonds that you have in your portfolio, that we're paying ourselves back. And it gets back to the dollar, it gets back to the global currency. We haven't had other than a little blip on printing the money and selling it. I'd hate to be in that position, trying to figure out where on the curve to sell it. But no question about it, every empire ended that way. People stopped lending them money and it tipped over. There's a guy that we like that's an economist. He's another Scotsman, an economic historian that has a data point for that. he's gone back and taken a look at like the Roman Empire, every empire that failed, and it's a crossover point, and we crossed over it, and we heard it from the media, the amount of money that it takes to carry the debt as opposed to the amount of money that it takes to defend the perimeter, to defend the borders, military. So we crossed over that, and what he believes is that that's a benchmark for it to begin to unravel. But what he also believes is it takes 80 years. Right? So I'm not saying that we shouldn't be fixing this now. It's so much easier to fix it now. Most of us had a fix. I mean, my Social Security age was changed from 65 to 67, right? All they have to do is change it from 67 to 68, and the problem probably goes away, right? Or just lift up the unemployment tax, but we can't seem to, to have the conversation. So, I mean, Churchill always said, it's not a direct quote, the Americans are really good at doing what they need to do when all other options have been exhausted. That's what this feels like.
We've also seen a major shift in top tax rates since Reagan, since before Reagan. I mean, the top tax rate before Reagan was 7%.
Yeah.
So, I mean, and how many people now, the rich people now are paying virtually nothing in taxes? And what did that look like 40, 50, 60 years ago? Right?
Yeah.
There's a simple solution to that.
Simple solution, just hard to get reelected if you vote for it.
Yeah.
Yeah, I agree with you. I mean, I can't believe it really, and Hunter's not going to believe it, but because I'm a tax cutter, supply sider, fiscally hawkish, right? Obviously, I'm on a tear about the debt. I'm a fiscal hawk, but you're absolutely right about that. And what do we do in this bill? We stop taxing Social Security. I don't understand it. Plus, I'm not on Social Security, so seems like we're going in the other direction. But it isn't a bill yet; it's just in the Senate. So. I don't, but I don't, and compliance people, I'm telling you, I don't have the chart, but I think it's around 7%. That's the first number that popped into my head. Yeah, so one side would argue we can grow our way out of it, right? And other people would argue that we could spend our way out of it. That's insane. Yeah.
But as a percentage of GDP, it's no worse than it's been.
Oh no, it's a lot worse than it's been. 7% is a lot worse than it's been. So I don't know what it was in the Reagan years, for example, but I think it's doubled or so.
Last time it was this high was World War II.
Yeah.
And we're not in a world war. Right
Yeah, that's a great point. Thank you, Hunter. Yeah. So to have this high at peacetime is unprecedented. Yeah, we got to fix it. So enough about the debt. Let's get to everybody's favorite part of our show today, the predictions. So we always start with some easy ones. It's going to rain for the 14th weekend in a row. Saturday, the president will change his mind, like Hunter says, a lot. This will create economic turmoil. And epic volatility in the market. Seriously, people, hang on to your hats. Think about what we said about how you own these things and research them, and call us if you're really in a panic. I think this is going to be wild. We're halfway into love him or hate him. He is exhausting, man. So I think we're in the first 6 months or 3.5 years of a wild ride. Here's one, the big, beautiful bill. Now we're getting taking a little bit of risk in our predictions. The big, beautiful bill will pass and be signed into law. Sorry. It's going to be. That's what we think. And we think that because Democrats and Republicans, major fat cat donors, need to have it happen. Taxes and money makes the world go around. We think it's going to get passed into law. We think that the tariffs are going to settle at 10% across the board, plus whatever happens with China. To say that, like whatever happens with China is easy to say, but it's critically important to the volatility of the economy and the future of the United States of America. Apparently they had a phone call. I can't wait to see what happened while we were in there. Wait, just kidding. I just want to go have a pizza. Yeah, good call. Yeah, thank you. And then GDP, this is interesting to me. The numbers are really coming in hot. GDP is going to be like 3.5% or more this quarter. We're going to see growth. So if I like the stagflation comment, Tony, because I always like to come up with words that the media is going to latch onto and take to the bank and torture you with. And I think that's one of them. And I think the hot GDP is going to be one of them too. So the Republicans are going to say, oh, this is all working. Look at the growth. We're going to grow our way out of the deficit, right? And the liberals are going to say it's way too hot, inflation, tax, these tariffs are causing, you just have to flick back and forth. It's like a tennis match between the channels, and you can and you can see it. But we think GDP is going to come in at over 3.5%, which is pretty epic growth. No, fake numbers, So GDP is just a government statistic that has nothing to do with reality. And what's driving it is what you pointed out, Tony, earlier. Thank you. It's the front running, and numbers, being pulled around.
With respect to the numbers coming out of the government, they've done a good job of getting rid of all the experts that look at financial data and put predictions together with respect to inflation and everything else like that.
Yeah.
So the offices that did that work are a shell of what they were 6 months ago.
Mm-hmm.
How much stock can we actually put in any numbers coming out of them at this point in time where they've gotten rid of all the internal, external experts that were doing the work?
Yeah. So my answer to that, I'm probably not going to like the answer, sorry, but my answer to that is I'd rather have a financial analyst do that worked for a publicly traded company that's a bond trader. And that I have no belief, you just heard what I said about the government statistics. It reminds me, I had a client, great guy, fun guy, he's an actuary, and he said, I'm worried about Social Security. And I, went through my, don't worry about Social Security, they can't do it, it would be insane. That doesn't help. He wasn't listening, because he thinks he's dealing with insanity. And then it doesn't make any sense because people live on Social Security. It would just tank the global economy. It really, it really would. But he said, no, I'm not worried about them paying me. I'm worried that Doge is going to get in there and they're going to mess it up and they're not going to cut the checks, and then we're going to have, civil war. And again, it's not a great answer, but I would say that the capability of Social Security to mess that up is about equal to the capability of Doge to mess that. I mean, Social Security, have you ever tried to call them? I mean, I think that they could do it with the click of the button. So I don't worry about the government's analytics. I worry about Goldman Sachs's view of that because they forensically account for it. Okay, the last prediction, Dow 50,000. That came from Hunter because it's the scariest one. But we really believe that the Dow will go to 50,000. It won't take ridiculously long. It's only about 15% from where we are right now. The other half of that is we don't know if it's going to go to 20,000 before it goes to 50,000. But we believe in the U.S. economy. You're getting the feel for that. We don't think it's time to stick our heads in the sand. And really what everybody, at the end, everybody wants to know, what's really going on? What are you thinking? And I'm going to frame it this in the board meetings. We had the investment committee and the investors come in. These guys are unbelievable asset managers. To go through the outlook at the end of the quarter, right in the middle of the tariff tantrum. It was a great time to meet. And then the board all got together. I mean, these are people from all over the world. It's really cool. So what happens is when you get into the pub and the coffee shop afterwards, you really, get the conversation going. And the consensus is the foundation is going to be fine. The endowment is going to be fine. The consensus is the endowment is going to grow. The message here to you guys is the middle class is probably going to get rich off of this, right? And the other part of the message is that it's all our social responsibility to, help everybody out, right? In the foundation, it's easy to describe. Let the money grow, invest it, don't be embarrassed by it, and give it away. It's more money to give away. Because I really do think that the bottom end of the social tier isn't going to come out of this that hot. So you guys are in the middle market. You're not the foundation, but it's the same principle, isn't it? I think what's going to happen is your balance sheets are going to look great with everything that we just described. We're not worried about it. What we're worried about are the social issues. and encourage you to handle that with your social capital and not feel guilty about growing it up. Help the kids, help the next generation, help the people that really need the help. And that's what we really think is going on here. And our last prediction is that because you took the time to come today, that you're going to have the best summer ever. Because you're going to stay focused and not watch the news. And that is our June 2025 market update. Thank you.